Hey everyone, welcome back to Trading Mindset Lab. I'm really excited to have you here today. In this episode, I'm going to introduce you to one of the most powerful and eye opening books ever written on trading psychology and real world strategy. It's called Market Wizards by Jack D. Schwager. This is not just another trading book, it's a deep dive into the minds of some of the greatest traders of all time. People who turned discipline, mindset, and risk control into an art form and made millions, even billions, along the way. Whether you're new to trading or already years into the game, this book will challenge the way you think. It will teach you that success isn't about being right all the time. It's about how you think, how you manage yourself, and how you survive when the market turns against you. So grab a coffee, sit back, and let's uncover the hidden lessons inside Market Wizards, told through stories, quotes, and insights that will change the way you trade forever. Let's get started. Market Wizards by Jack D. Schwager, Part 1. When one thinks of Wall Street legends, what often comes to mind are flashy headlines, billion-dollar trades, and high-stakes drama. But Jack D. Schwager's Market Wizards peels away the myths and dives deep into what actually makes the greatest traders succeed. This book is not a textbook, not a step-by-step guide, but rather a rare look into the minds of those who have mastered the craft of trading. It is an anthology of real conversations, offering not just techniques, but philosophies, mindsets, and personal journeys. What sets this book apart is not that it offers a formula for trading success, but that it proves no such formula exists. There are as many styles as there are traders. Some rely heavily on technical analysis. Others dig into fundamental data. Some never look at news, and others obsess over macro trends. The unifying thread is not what they trade or how they trade, but how they think about trading. Schwager's interviews are structured yet casual. They capture the nuance and emotional texture behind each trader's story. He does not spoon-feed takeaways. Instead, he invites the reader to read between the lines. What emerges is a tapestry of mental models, risk frameworks, and decision-making habits that can only come from the trenches of real markets. Perhaps the most powerful idea that runs through the book is that trading is not about being right. It is about managing risk. Some of the traders interviewed openly admit that they are wrong more than half the time. But when they are right, they make it count. They are masters of asymmetry, cutting losses early and letting winners ride. This is not just a rule. It is a discipline so ingrained in them that it has become instinct. Take, for example, the insights from a trend-following trader. He describes his strategy in the simplest terms. Follow price, not opinion. If the market moves against him, he gets out. No argument, no negotiation. If the trend continues in his favor, he holds on. This sounds easy, but behind it is a fierce commitment to emotional detachment and probabilistic thinking. It is this emotional intelligence, more than charts or indicators, that separates professionals from amateurs. Another standout theme in the book is the idea that great traders are not adrenaline junkies. They are not trying to get rich quick. Many of them have endured long periods of loss or stagnation. They speak of setbacks, of questioning their own methods, and of the psychological toll that comes from underperformance. But what they have in common is resilience. They learn, they adapt, and they never stop refining their process. Interestingly, very few of the traders profiled claim to have discovered anything revolutionary. Their edge comes from doing the basics better than everyone else. They control risk more rigorously. They study their trades more carefully. They manage their emotions more effectively. And perhaps most importantly, they have tailored their approach to suit their own personalities. This is a major point Schwager hammers home without explicitly stating it. No one can succeed long-term by copying someone else's system. The best system is the one that you believe in, that fits your psychology, and that you can execute with discipline over time. The chapter involving a short-term trader gives us a glimpse into a completely different world. Here, speed and precision take center stage. Decisions are made in seconds. Patterns are spotted in micro shifts in momentum. But even in this rapid-fire environment, the same principles apply. Manage risk, stay disciplined, and stay humble. This trader talks about the importance of not letting one win create overconfidence. He stresses the danger of letting a loss trigger revenge trading, The mind must remain calm, focused, and centered, no matter how volatile the market. The book also touches on the loneliness of trading. Many of the most successful traders work alone. They do not rely on teams or consensus. They are not looking for validation. This solitary nature is both a strength and a burden. It allows for clarity of thought, but also demands psychological strength. The trader is both the pilot and the mechanic of the machine. No one else can take responsibility for the outcome. There is a section in which a macro trader explains his view of the world. He talks about understanding the global chessboard, interest rates, currencies, politics, economic cycles. He does not trade from charts, he trades from themes. But even here, the humility remains. He does not pretend to know what will happen. He builds trades around probabilities and manages them like a portfolio manager. He sizes positions based on risk exposure, not conviction. This is where the book truly shines. It dismantles the myth of the all-in genius who bets the farm and wins. The real masters never bet the farm. They bet a small percentage and always live to fight another day. A recurring lesson through interviews is the value of loss. Loss is not failure. Loss is tuition. Every trader in the book has lost money, sometimes millions. But the great ones use those losses as feedback loops. They review, they journal, they evolve. One trader mentions that every losing trade tells him something about himself. Was it impatience? Overconfidence? Poor timing? The loss is a mirror. The profits are often just noise. One of the most inspiring moments comes from a trader who made his fortune after years of obscurity. He talks about persistence, about working in obscurity, and about staying focused when no one is watching. His message is simple. If you love the game, you will keep playing even when you are losing, and eventually, the edge shows itself. Another trader discusses how important it is to remove ego from the process. He points out that the market does not care about your opinion. It does not reward intelligence. It rewards discipline and flexibility. If you are wrong, admit it and move on. He compares trading to chess, not because it is an intellectual contest, but because it requires constant recalibration. What matters is the next move, not the last mistake. Throughout the book, Schwager offers subtle commentary. He does not inject himself too much into the narrative, but when he does, it is to highlight a pattern or point out a contradiction. He is the perfect narrator, curious, respectful, and quietly analytical. His questions draw out the deeper truths from each trader. He lets them speak for themselves and trusts the reader to draw the right conclusions. What makes Market Wizards a timeless book is that it is not just about trading. It is about decision-making under uncertainty. It is about mastering oneself. It is about performance, pressure, psychology, and process. Anyone who works in a high-stakes environment can relate to these stories. The markets are just the backdrop. The real drama is internal. In conclusion, this first portion of Market Wizards offers more than a collection of interviews. It offers a mirror. Every reader will find a piece of themselves in these pages: the doubt, the excitement, the mistakes, and the breakthroughs. It does not matter if you are a novice or a seasoned professional. The lessons here are universal. There is no formula, no shortcut, and no single path to success. But there is a mindset, and that mindset is the true wizardry of the markets. Lessons from the Market Wizards. In the second part of Schwager's Market Wizards, the tone shifts subtly. After introducing the personal journeys of these elite traders, the narrative begins to crystallize into something more tactical. This is where the reader starts to collect the gold nuggets, not as formulas, but as enduring lessons that apply to both trading and life. What becomes immediately obvious is that the most successful traders do not seek to avoid loss. They seek to control it. Over and over again, these individuals emphasize the importance of risk management as the foundation of their success. One trader likens it to survival in the jungle. You do not have to win every fight. You just have to make sure you live to fight another day. Take the recurring lesson of position sizing. Virtually every trader in the book stresses that proper trade size is even more important than entry timing or market prediction. One describes how he learned the hard way that even the best idea can be destroyed by overexposure. A position that is too large becomes emotionally unmanageable. It clouds judgment. It turns a calculated risk into an all-or-nothing gamble. Another trader, known for exceptional trend following, explains that he wins on only a fraction of his trades. But when he wins big. And when he loses, the damage is minimal. His system is not designed to predict. It is designed to react. If a price trend emerges, he rides it. If not, he exits swiftly. His discipline is almost mechanical. Yet, underneath that discipline is a clear respect for the randomness of markets. That is another core theme throughout the book: respect for uncertainty. Many of the traders interviewed express a form of intellectual humility. They do not pretend to know the future. They are not in the business of certainty. They are in the business of managing probabilities. This mindset stands in stark contrast to the common image of the all-knowing trader who makes bold, heroic bets. The real wizards are conservative, skeptical, and always questioning their own assumptions. There is also an obsession with process. One of the most consistently echoed lessons is that process trumps outcome. Winning on a reckless trade is not a success. Losing on a disciplined trade is not a failure. What matters is the integrity of the process. Traders build systems, test strategies, and create rule sets not because they guarantee profit, but because they reduce emotional interference. Take, for example, a trader who built an algorithmic approach decades before it became fashionable. He describes the psychological relief of removing emotion from the equation. His rules are tested over years of data. Once in the trade, he does not second-guess the system. He follows it blindly, not out of faith, but because he knows human emotion is the weakest link in trading. The system does not get scared. It does not get greedy. It just executes. Emotional control is a theme that cannot be overstated. Many traders speak about the battle within, the fear of missing out, the temptation to double down, the desire for revenge after a loss. One veteran trader describes losing control after a string of small wins. Feeling invincible, he took a massive position and gave back weeks of gains in a single day. It was a painful lesson, but one he never forgot. Several traders emphasize the importance of maintaining a detached mindset. They do not fall in love with their trades. They do not argue with the market. When price action invalidates their thesis, they exit without hesitation. It is not personal. It is not emotional. It is professional. This emotional neutrality is perhaps the hardest skill to develop, but it is what separates consistency from chaos. Another powerful theme is adaptability. The markets are dynamic. What worked yesterday may not work tomorrow. The best traders are constantly evolving. They read, they study, they backtest, they analyze mistakes. One trader recounts how his method stopped working after a decade of consistent success. Instead of forcing the system to work, he went back to the drawing board. Humbled but determined. Reinvention is part of the game. At the same time, there is caution against overcomplication. Many traders reject the idea of using too many indicators or strategies. They prefer simplicity. One veteran calls it clean trading. He uses basic price action, a few moving averages, and sound money management. Nothing more. His logic is that the more variables you introduce, the more room there is for conflict and confusion. Simple is scalable. Simple is sustainable. That said, the simplicity is often deceptive. Behind it is rigorous discipline, detailed journaling, and tireless review. Several traders describe keeping trading journals not just for performance tracking, but for emotional auditing. What was I feeling when I took that trade? Did I follow my rules? What pattern did I miss? This habit creates a feedback loop that strengthens self-awareness. Perhaps one of the most surprising lessons is how little emphasis the best traders place on market forecasts. Many admit they have no idea where the market will go next. What they care about is how to respond to what the market actually does. They wait for confirmation. They trade with the trend. They respect momentum. This reactive approach may sound passive, but it is anything but. It requires alertness, patience, and decisive execution. The book also reveals how different trading timeframes demand different mindsets. A day trader talks about laser-sharp focus during market hours with decisions made in minutes or seconds. He stresses recovery routines, mental resets, and even physical exercise as part of his edge. In contrast, a long-term macro trader takes weeks to build a thesis, tracks geopolitical developments, and sizes positions to withstand wide swings. Both are masters, but of very different games. A particularly striking interview involves a trader who emphasizes the psychological side above all else. He suggests that every trade is a mirror of the self. The losses reveal your weaknesses, the wins tempt your ego. Mastery is not just about technical skill, it is about emotional maturity. In his view, trading is not just a profession, it is a path of self discovery. From all of these voices, a few universal rules begin to emerge. Always control your risk. Never trade without a plan. Be humble enough to admit you are wrong. Be confident enough to act when you are right. Stay consistent, but remain adaptable. Do not chase the market. Let it come to you. Focus on process, not outcome. These are not cliches. They are hard-earned truths, forged in the fire of real money and real consequences. And they are delivered not as commands, but as reflections. Each trader in Market Wizards had to learn these lessons through personal experience. Schwager does not preach, he observes. He lets the story speak. By the end of this portion of the book, the reader begins to see the outline of a deeper truth. Trading is not about finding a secret. It is about mastering yourself. The rules are simple. The execution is hard, but the rewards for those who endure are not just financial. They are psychological. They are intellectual. They are personal. And that is what gives Market Wizards its staying power. It is not a book about trading. It is a book about decision-making, discipline, and human nature under pressure. The charts may change, the tools may evolve, but the principles remain. The wisdom in these pages is timeless because the human mind and its struggles never go out of style. As the interviews in Market Wizards unfold, a powerful counter-narrative begins to form. While the first two parts of the book explore the habits and philosophies of great traders, this section is an anatomy of failure. Not because Schwager set out to embarrass anyone, but because even the most successful market participants have stumbled and learned from costly mistakes. Reading these stories, a chilling truth becomes clear. The difference between surviving and blowing up is often one or two bad decisions made in the heat of the moment. These are not rare blunders. They are common missteps that countless traders make. And what makes them so dangerous is that they often follow success, not failure. One of the most frequently repeated mistakes is trading too large. It usually begins after a string of wins. The trader feels in sync with the market, invincible even. Confidence morphs into overconfidence. And then comes the oversized position, the one trade meant to accelerate profits, to fast-track a breakout year. But when the market moves against them, as it inevitably does, the losses are magnified. The account that was growing slowly and steadily is now bleeding uncontrollably. Several traders confess that their biggest losses did not come from bad market analysis, but from position sizing errors. One even jokes that the moment he feels smartest is when he needs to reduce risk the most. This insight might sound ironic, but it carries deep truth. In trading, confidence is not always a virtue. It is often a warning sign. The great traders do not think in terms of certainty. They think in terms of probability. And they size their positions not according to how they feel, but according to what they can afford to lose. Another mistake that appears repeatedly is trading without a clear plan. It seems simple. Have a strategy, define your entry, set your exit, manage your risk. But in practice, this structure is often replaced by emotion, especially when traders are under stress. One interviewee describes the experience of waking up to a sudden market move, feeling pressure to act, and placing a large order purely on instinct. It was not in his plan. He had no setup, but he did it anyway. The trade went south, and the regret was instant. Trading without a plan is gambling. And what Market Wizards teaches, sometimes painfully, is that markets are not the place for improvisation. Every trade must be backed by a reason, not a reaction. If you cannot define why you are entering, where you will exit, and what your risk is, you have no business being in the market. Perhaps the most dangerous mistake, and the one most emotionally charged, is refusing to take a loss. The psychology behind this is deeply human. No one likes to be wrong. No one enjoys admitting failure. But in the markets, denial is expensive. Many traders in the book talk about the temptation to hold on to losing trades in the hope they will bounce back. They use words like hope, patience, and belief. But hope is not a strategy. One trader describes how a single loss, if not cut quickly, can spiral into a career-ending disaster. He refers to it as the cancer trade, a position that starts small but grows quietly and uncontrollably. By the time the trader acknowledges it, It is too late. The damage is irreversible. The account is blown, the confidence is shattered, and the lesson, if learned, is paid for in full. The refusal to accept small losses stems from ego. It is the need to be right. But as many traders in the book remind us, being right is not the goal. Staying in the game is. Losses are part of the process. They are not evidence of failure. They are evidence that you are following your system. The problem is not the loss itself. The problem is when you ignore your own rules to avoid it. A particularly memorable section involves a trader who explains how he used to let losing trades consume his mind. He would stare at the screen, watching the red numbers tick, paralyzed. He was not just losing money, he was losing emotional control. It took years for him to develop the discipline to exit a trade mechanically, without debate. Now, he says, if a trade hits his stop, he walks away. There is no conversation, no justification, just execution. Emotional trading is another silent killer. Trading decisions made out of fear, greed, revenge, or boredom rarely end well. One trader describes how, after taking a loss, he would immediately jump back into the market, trying to get it back. This revenge mentality, he admits, led to some of his worst trades. The need to recover quickly led to reckless behavior. Only after building emotional distance did he begin to trade with consistency. The book does not spare anyone from criticism, not even the legends. Schwager highlights moments when even the best traders broke their own rules. But he also shows how those moments became turning points. The difference between a blow-up and a breakthrough was not the mistake itself, but the response to it. The great traders take ownership. They analyze. They evolve. There is also the mistake of overtrading, of trying to be active all the time. Many traders talk about the importance of sitting on your hands, of waiting for high-probability setups. But this is easier said than done. The markets are always moving. The temptation to act, to participate, is constant. But not every market environment is tradable. Sometimes the best trade is no trade. A trader shares how he used to force trades just to stay engaged. He would convince himself that a mediocre setup was actually good. Over time, these forced trades chipped away at his capital and confidence. It was only after he imposed a strict 3-trade-a-day rule that he began to see real improvement. Limiting his activity forced him to become more selective, more patient, and more focused. Finally, one of the most profound mistakes is neglecting the psychological side of trading. Many beginners focus entirely on strategy and ignore mindset. But the mind is where most trades are won or lost. The best system in the world will fail if the trader lacks discipline. Conversely, a decent system can perform well if executed with emotional control. The traders in Market Wizards make it clear that self-awareness is critical. You need to know your own triggers. Are you vulnerable to overconfidence? Do you panic under pressure? Do you freeze when losses mount? These are not just personality quirks. They are risk factors, and the sooner you recognize them, the faster you can adapt your style to manage them. In the end, mistakes are inevitable. Every trader makes them. The key is to survive them. The market does not punish mistakes. It punishes arrogance. It punishes denial. It punishes those who fail to learn. The traders who last are not the ones who never fail. They are the ones who fail fast, fail small, and fail forward. What successful traders have in common? By the time one reaches the later chapters of Market Wizards, a quiet realization begins to form. Despite their vastly different strategies, some relying on algorithms, others on instinct, some trading in seconds, others over months, these market veterans share something deeper than methodology. They share a certain internal architecture. Their success does not rest on a secret technique. It rests on how they think, how they adapt, and how they manage themselves under pressure. Perhaps the most essential trait is adaptability. This is not a cliché about being flexible. It is a strategic commitment to evolving in response to new information. Time and again, Schwager's interviewees describe moments when the market proved them wrong. Not once, repeatedly. Yet they did not cling to their predictions. They adjusted. They respected the market more than their own opinions. One trader compared it to sailing. You can have a destination, but the wind decides your route. This adaptability is not passive. It is active recognition that the market is an unpredictable and often irrational organism. When reality contradicts the forecast, the successful trader changes the position. not the facts. This requires more than intellect. It requires humility and emotional detachment. Pride has no place in a profession where wrong decisions cost real capital. Yet within that humility lies a paradox. The best traders are also remarkably confident, not in a loud, boastful way, but in a quiet, self-assured way. They trust their edge, they trust their system, they trust their ability to execute. However, that confidence is balanced by self-doubt. Not the destructive kind, but the constructive kind. The kind that constantly asks, what if I am wrong? This balance between conviction and openness is rare, and it is powerful. One trader said it best. Confidence without arrogance is the sweet spot. Arrogance assumes the market must agree with you. Confidence accepts that the market does not care, but you have prepared to navigate whatever it brings. This mindset creates a mental flexibility that allows for both bold action and rapid course correction. Another unshakable trait across the board is a relentless focus on process over outcome. Many traders in the book emphasize that profits are not the goal. They are the byproduct. The goal is consistency. The goal is following the rules. The goal is execution. One trader likens it to flying a plane. Your job is not to guarantee arrival. Your job is to run the checklist, fly the route, and manage the cockpit under all conditions. This focus on process manifests in many ways. For some, it means following a set of mechanical rules. For others, it means journaling trades and tracking metrics. But in all cases, the message is the same. Good process leads to good results, over time. Bad process may work once, but eventually it breaks. The market rewards discipline, not drama. Discipline, however, is not just about sticking to a plan. It is also about refining that plan through continuous learning. This is another powerful commonality. Every successful trader interviewed by Schwager is a lifelong student. They read, they study charts, they review their own trades with brutal honesty. One trader explained that after every trading day, he would spend hours replaying the market in his mind. What worked, what failed, and most importantly, what he missed. This commitment to improvement is not about perfection. It is about sharpening the edge. And it often happens in solitude. These traders are not seeking social validation. They are not impressed by opinions on television. Their learning is internal, driven by the desire to master the game and themselves. In many ways, they treat trading the way a professional athlete treats a sport, with repetition, feedback, and relentless refinement. Closely related to this is the practice of record keeping. Surprisingly, a vast majority of these traders maintain some form of a journal, not just for numbers, but for thoughts, for emotions, for triggers. One trader recalls how journaling helped him discover a pattern. He would often enter trades impulsively after reading a certain financial blog. Once he saw it in writing, he changed his routine, and his results improved. The journal is not a diary, it is a mirror. It reflects what the trader may not want to see but needs to confront. It also becomes a database of past behavior, a resource for analyzing strengths and weaknesses. Over time, the journal becomes a silent mentor, a map of one's journey through the markets. From all these patterns, we can extract the following profile of a successful trader. They are adaptable, willing to change course without emotional resistance. They are confident but grounded, always questioning assumptions. They obsess over process and execution, not just short-term profits. They invest in themselves, learning relentlessly and independently. They document everything, not for nostalgia, but for self-analysis. And above all, they view trading not as a job or even as a profession, but as a performance discipline. Like musicians, they rehearse. Like athletes, they condition. Like artists, they analyze form and flow. This is not casual work. It is deliberate. It is intentional. It is crafted. Jack Schwager does not force these conclusions upon the reader. He reveals them slowly through layered conversations. He lets the themes emerge organically, and that is what makes them powerful. They are not textbook rules. They are lived truths. In the end, what these traders share is not a strategy. It is a standard for how to think, how to act, and how to improve. That is the real edge, and it is available to anyone willing to do the work. Quotes that define the market wizards. Among the many powerful ideas captured in Market Wizards, there are certain quotes that linger in the mind long after the final page. They are brief, often no longer than a sentence or two, but they encapsulate truths that took years, sometimes decades, of trading experience to learn. In a field crowded with noise and hype, these statements cut to the core. Let us begin with a line that has become almost legendary in trading circles. Paul Tudor Jones: "The most important rule of trading is to play great defense, not great offense." This quote flips the common narrative on its head. Most people outside the trading world imagine that success comes from bold bets and brilliant calls. But Paul Tudor Jones, one of the most successful hedge fund managers of all time, insists otherwise. In his world, survival is the priority. Protection of capital is the foundation. Offense, meaning aggressive profit seeking, only matters after defense has been secured. What he means is clear. You cannot win if you are knocked out of the game. You can only take risks once your downside is controlled. This mindset reframes trading as a defensive sport. The goal is not to conquer the market. The goal is to avoid being destroyed by it. That means stop losses, position sizing, diversification, and psychological boundaries are not just tools. They are lifelines. And this brings us to a quote that adds another layer of psychological insight. Seykota: "Win or lose, everybody gets what they want out of the market." At first glance, this might seem puzzling. After all, who wants to lose money? But Seykota, a pioneer in trend-following systems, is speaking on a deeper level. He is referring to the subconscious forces that drive behavior. Some people unconsciously seek excitement. Others want to prove they are right. Some crave punishment. The market becomes a mirror, revealing the trader's internal motives. In other words, the market does not just respond to your trades, it reveals your character. If you crave drama, the market will give it to you. If you need to feel right all the time, the market will test that desire until it breaks you. Seykota's insight reminds us that self-awareness is not optional. It is essential. Before you can master the market, you must confront your own internal wiring. His quote is not just about psychology. It is about accountability. You may say you want profits, but your actions, your oversized positions, your refusal to cut losses, your emotional trades may suggest otherwise. The market will not listen to what you say. It will respond to what you do, and it will give you exactly what your behavior deserves. Then comes a statement of ruthless clarity from another trading legend, Bruce Kovner: "Risk management is the most essential part of your system." This quote carries the weight of experience. Kovner, a former currency trader who built a multi-billion-dollar fund, could have spoken about models, indicators, or macro themes. Instead, he highlights one thing: risk. Not entries, not exits, risk. Why? Because risk is the one factor you can control. You cannot control the market. You cannot control what news breaks overnight, but you can control how much you are willing to lose. Kovner's point is that any system, no matter how intelligent, will eventually face drawdowns. Without strong risk management, even a good system can collapse. With it, even an imperfect system can survive long enough to improve. These three quotes, when viewed together, form a powerful framework. Paul Tudor Jones reminds you that protecting capital is job number one. Seykota reminds you that trading reflects your inner world. Bruce Kovner reminds you that without risk control, nothing else matters. But there are many more lines throughout Market Wizards that carry quiet wisdom. One trader says, "The best trades are the hardest to take." This speaks to the emotional resistance that often accompanies high-quality setups. When fear is high, the market is usually offering the best opportunities, but only those with courage and clarity can act. Another trader observes, "If you personalize losses, you can't trade." This is a stark warning against ego. Losses are not a reflection of your worth. They are data points. They are necessary, even helpful, if used correctly. But once you attach identity to outcome, you are no longer trading the market. You are defending your pride. There is also this line: "The market is an expensive place to find out who you are." Brutal and true. The market has no sympathy. It does not care about your goals, your dreams, or your narrative. But it will expose your weaknesses with perfect precision. Every hesitation, every overreaction, every blind spot, it will all be illuminated, and it will cost you. What ties all these quotes together is that they are not technical. They are philosophical. They are reflections from traders who have been broken and rebuilt by the market. Their words are not advice. They are experience, compressed into a few unforgettable sentences. Perhaps that is why Market Wizards remains so enduring. In a world where trading books often become obsolete with each market cycle, this one continues to resonate. The charts may change, the platforms may evolve, but human behavior remains the same. And these quotes, these compact insights, are timeless. They remind us that trading is not just about strategy, it is about survival, about self awareness, about discipline, and about the quiet strength required to play the long game. The Real Edge, according to Jack D. Schwager. As the final pages of Market Wizards unfold, Jack D. Schwager steps back from his role as interviewer and assumes the voice of a quiet observer. He has spent countless hours with some of the greatest traders of our time, listening, probing, learning. And now, with the benefit of distance, he offers his core conclusion. It is not wrapped in sensationalism. There is no magic formula, no cheat code, just a clear, honest message that hits deeper than any trading tactic ever could. Success in trading does not come from being able to predict the market. It comes from mastering yourself. This might sound simple, too simple for a book filled with so many brilliant minds. But Schwager's insight is deceptively profound. Over the course of dozens of interviews, he observed that the most consistent trait among top traders was not their forecasting ability. It was not how often they were right. It was how they managed risk, controlled emotion, and executed a strategy with discipline. This final insight is not just a summary, it is a revelation. The market, Schwager implies, rewards behavior, not intelligence. It rewards process, not prediction. And above all, it rewards emotional resilience. In many ways, this conclusion dismantles the myths that surround trading. The myth that you need to call tops and bottoms. The myth that great traders are always right. The myth that instinct or brilliance can replace preparation and risk management. Schwager reveals the truth. Success in trading is earned not through genius, but through consistency, structure, and discipline. At the heart of it all is risk management. No matter how elegant a strategy may be, if it does not incorporate a clear framework for controlling losses, it is doomed to eventual failure. Schwager saw this theme repeat like a drumbeat across every conversation. The best traders never bet more than they can afford to lose. They do not chase losses. They do not double down in anger. They protect their capital with a defensive mindset, even while pursuing profits. But risk management alone is not enough. The human element must be mastered. Schwager places significant emphasis on emotional control, the ability to stay calm when others panic, the humility to admit when a position is wrong, the patience to wait for the right setup, the discipline to follow a system, even when it feels uncomfortable. These emotional competencies, he suggests, are often more important than analytical skill. And then comes the third pillar, a rules-based approach executed with discipline. All the traders Schwager interviewed had some kind of edge, a method that gave them a slight statistical advantage. But what separated them from the crowd was not the edge itself. It was their ability to follow it, day in and day out, without deviation. They did not trade based on feelings or intuition. They traded based on tested principles, and they respected those principles even in the face of loss. Schwager also points to another powerful truth. There is no single path to success. The traders he interviewed used wildly different approaches. Some were trend followers. Others were contrarians. Some used technical indicators. Others relied on macroeconomic analysis. The takeaway? There is no perfect system. The key is finding a method that fits your personality, time horizon, and risk tolerance, and then sticking with it. He also emphasizes that losses are inevitable. Even the best traders lose frequently. What matters is how those losses are handled. Are they small and controlled? Are they part of the plan? Are they reviewed and learned from? For the successful trader, a loss is not a failure. It is data. It is feedback. It is part of the process. In his final reflection, Schwager strips trading down to its essence. It is not a game of brilliance. It is a game of execution. The market is a neutral force. It has no memory, no emotions, no loyalty. It simply reflects the sum of all participants' actions. In this environment, the trader who survives and thrives is not the one with the fanciest tools or the boldest predictions. It is the one who can stay grounded while others lose their balance. The real challenge of trading, as Schwager makes clear, is not external, it is internal. The greatest obstacles are not the market's volatility or complexity. They are impatience, fear, greed, denial, and overconfidence. The market simply exposes what is already within you. And so, the final takeaway of Market Wizards is this: trading is not about being right, it is about being prepared. It is not about controlling the market, it is about controlling yourself. It is not about chasing profits, it is about building a process that allows profits to find you. Schwager does not end the book with a proclamation. He ends it with perspective. After sitting with the best, listening to their stories, absorbing their wisdom, he offers the reader a choice. You can chase strategies, or you can build a system. You can chase thrills, or you can pursue mastery. The market allows for both, but only one leads to long-term success. That is the legacy of Market Wizards. Not a blueprint, not a prediction model, but a mirror. A reminder that before you can master the markets, you must first master yourself. Final thoughts. The wisdom inside Market Wizards goes far beyond technical charts or trading strategies. It is a journey through the minds of people who mastered not just the market, but themselves. If there is one lesson that echoes through every chapter, every quote, and every mistake, it is this: trading is not about being right. It is about being disciplined. It is not about prediction. It is about preparation. No matter where you are on your trading journey, just starting out, refining your system, or recovering from setbacks, remember this: your greatest edge is your mindset. And like the market itself, your mindset can evolve. It can grow stronger, sharper, and more resilient with the right tools, the right insights, and the right community. Thank you for spending time with us today. If you found this content valuable, if it gave you perspective, clarity, or even just a few moments of inspiration, please consider subscribing to Trading Mindset Lab. Here, we dive deep into trader psychology, discipline, risk management, and real-world insights from legends who have walked the path before us. No hype, no shortcuts, just the mindset behind long-term success. Hit that subscribe button, like the video, turn on notifications so you never miss an episode. Let's grow together, one trade, one mindset shift at a time. This is Trading Mindset Lab, where traders are made from the inside out.